1 year ago, the catastrophic day that changed economic history. The collapse of one of the world's oldest investment banks caused a financial panic throughout the world. Have lessons been learned? Are we on the road to recovery? And could this happen again? This is Inside Story. Hello there, I'm Shili Ghosh. Thanks for being with us. The sudden and shocking collapse of Lehman Brothers, one of the most well-known financial institutions in the world, marked a seminal moment in economic history. It marked a dramatic meltdown across the globe, resulting in a credit crisis which has impacted on all of us. But in reality, it began a year before that with warnings in 2007 over US banks' subprime liabilities when bad debts began to outnumber their assets. And as banks realised they couldn't recoup on their losses, the panic started to spread. Let's take a look at some key moments in an economic year of hell. In September 2008, two major events happened. The government took over mortgage giants Fannie Mae and Freddie Mac. Shortly after, the investment bank Lehman Brothers went bankrupt. A month later, Iceland collapsed in dramatic fashion, taking with it investments from across Europe. During November, all countries in the Eurozone officially hit recession, as did Japan, the world's second biggest economy. In December, the US was officially declared to be in recession, though analysts acknowledged it had really begun a year previously. And in early 2009, the UK joined the list of economies in decline. Now, there are signs of some recovery. In the US, a Federal Reserve survey says economic activity is stabilising or improving in the majority of the country. France and Germany are officially out of recession. Well, joining us now are our guests. In London, Alistair Heath. He's editor of the business and finance newspaper City AM. In Prague, Peter Schiff. He's president of the brokerage firm Euro-Pacific Capital and author of the book Crash Proof: How to Profit from the Coming Economic Collapse. And here in Doha, Raghavan Sitaraman. He's CEO of Doha Bank. Gentlemen, welcome to you. So, is the worst over? Alistair, let's come to you first. What do you think?
Yes, I think in the short term the worst is over. The world's economies have come out of recession. Unfortunately, unemployment is still growing very fast, and that's tragic for a lot of people. A lot of people, investors, consumers and so on, still feel as if they're in recession. But what the evidence suggests is that all the major economies are gradually coming out of recession, as you pointed out before. So I think compared to a year ago, I mean, it's astonishing how the world has changed. A year ago it seemed as if we're about to enter another Great Depression, that everything was going to collapse and so on. Now things are looking much better. That's not to say that the boom days are back. Thank God they're not back. But, you know, at least the economies are crawling forwards. There's a lot of problems still around for the future. A lot of the policies we've taken to prevent a Great Depression could lead to pretty bad things happening in a few years' time. But for the time being, at least, I think we can all breathe a sigh of relief. It's not been as bad as a lot of people feared, really, and gradually the situation's improving. I think that's at least some positive news.
Peter, what do you think? It's not been as bad as some people feared. It's been pretty bad, though, hasn't it?
Well, it has, and unfortunately for the United States, it's going to get a whole lot worse. I mean, the real economic crisis in America still looms. You have to remember how we got here. You know, the problems that we experienced in 2008 were the consequences of the economic stimulus under Alan Greenspan and George Bush. And they created the problems. And now, of course, we're in much worse shape. And the underlying problem is that we have some real structural imbalances in the U.S. economy that need to be resolved. And the market wants to resolve them. It's not painless. It's difficult to do that. But unfortunately, government policy, government stimuluses and bailouts and everything that they're doing is simply preventing the market from correcting these imbalances and worsening the underlying problems. So we're just going from crisis to crisis. And unfortunately, the currency crisis that's coming soon for the U.S. dollar will devastate the U.S. economy far more than what we had in 2008.
Let's just have a listen to what the White House economic advisor Lawrence Summers says. He thinks things are going to take time, but he says the world has stepped back from the brink.
To be sure, unemployment is substantially higher, and job loss has been greater than most observers predicted last winter, and unemployment is likely to rise in coming months. Recovery will take time, and history suggests that there will be setbacks along the way. Yet the pervasive sense of fear of 6 months ago has receded as strong measures have taken hold.
Raghavan Sitaraman, is this right that there is confidence creeping back into the market? And if so, are we now looking at a time when stimulus packages need to be wound down?
Let's understand the new world economic order. Conceptually, it's on account of the globalization, deregulation, technology and consumerism, and also on account of the infectious greed. The financial economies have to convert into real economies. Real economies have to clearly redefine the scope and performance. Clearly, auditors have failed, regulators have failed, rating agencies have failed. Where is the global governance? Where is the global transparency? Question remains, we see a sign of optimism, a cautious optimism consistently thrown across, whether it is stock market, sign of optimism is there. Again, commodity market is recovering, currency market, but for dollar, which is highly volatile, again, recovering. We also seen clearly reflection of the real economies in positive trend. The global growth is not going to be negative for next year, that much is sure. But we have to recognize still we have to go for wholesale transformation of the global regulatory framework. Otherwise, the common man is asking, what is this crisis all about? You know, conceptually is confused. So today we have to recognize the recovery is not stable and sustainable unless we have wholesale change in the global map and global governance.
So let's talk about that, because there was a lot of talk about greedy bankers, banks overstretching themselves, and a lot of talk about the need for greater regulation. Alistair, this is something that was discussed at the recent finance ministers' meeting in London. But is there a backing away now from actually reining in the banking industry?
Well, I mean, two things. First of all, I don't think so. I think that quite a lot of new regulations are about to
but they're not
arrive
going to cap them, are they? They're not likely to put a cap on bankers' bonuses.
No, I mean, you're not going to have 1970s-style quantitative limits on bankers' pay, no, but there's going to be regulation of how the bankers' pay is actually done and so on. But the point is, I don't actually think any of this is positive, really. I think it's missing the point completely, confusing cause for consequence. What happened over the past few years, and I think on that I agree with Peter Schiff, which is basically you had a liquidity and monetary-based bubble fueled by central banks and also global imbalances between West and East. You had all this very cheap money sloshing around. This cheap money, there's too much of it, pushed up all the prices of assets and things like houses and property and shares and bonds and so on. And eventually the bubble burst, and whenever these massive financial bubbles burst, they always take down with them the banking system. And during the bubble years, everybody's very happy.
With Raghavan's point that there needs to be global governance, more regulation, more accountability?
I think there needs to be.
Well,
I think banks have to be reformed. They need to hold much more capital and much better capital. Absolutely. I think there was a whole series of international rules previously, and they all failed. Absolutely. But I think that's part of the equation. But the other half is the central banks have to change their policies.
Peter Schiff, have we learnt our lessons?
No, unfortunately, no. You know, the free markets do a much better job of regulating than do governments. I mean, everybody has always been greedy. You know, greed is not a problem. In a free market, greed is always counterbalanced by fear. And so we don't act irrationally. People don't take too much risk. It's only when governments interfere in the free market, when you have things like government guaranteed debt, when governments come in and try to tell everybody that if there's ever a problem, we're going to bail you out. If you remember the Greenspan put during the 1990s, you know, Fannie and Freddie were guaranteeing mortgages so that lenders didn't have to worry about default. It's the governments that do this. And when the Federal Reserve makes money so cheap, when they make gambling riskless and costless, everybody's doing it. If interest rates had been allowed to rise, and they should have been much higher, none of this speculation would have been financeable, and the bubble wouldn't have inflated.
Well, the IMF boss, Dominique Strauss-Kahn, says the market economy needs rules to function. That's the lesson that's been learned. Without new rules, there will be a return to old behaviour. Do you not agree with that?
Look, you need No, you need basic rules. You need the rule of law. You need private property. But this was not a failure of markets. It was not a failure of capitalism. Far from it. It was a failure of government intervention. It was a failure of central banking. If we had honest money, if we had the free market setting interest rates instead of politicians, none of this would have happened. And you know, the problems for the global economy have always been exaggerated, and the problems for the United States economy have been diminished. I mean, the real problem for the world is the incredible cost of subsidizing the U.S. economy. And that's because the U.S. dollar is the world's reserve currency, and that's allowed the American economy to evolve in a way that is unsustainable. What America does is we borrow money from everybody else, and we consume things that we don't make. And we run these huge imbalances, and it is impossible for it to be financed. We have to allow a resolution of these imbalances. Unfortunately, the dollar has to drop, interest rates have to be allowed to rise, and America has to go back to a nation where we save money and produce stuff. And the longer we try to maintain this phony relationship, the more problems we're going to create.
Okay, let's take each of those points in turn. First of all, let me come to you, Raghavan. A rebalancing of the market economy. I mean, one of the things that the world is now looking at is increased power amongst the developing nations, and trying to get countries like China and Germany to export less and buy more. Are we going to see that kind of reorientation?
Absolutely. There's an absolute change in the market preference. We have to necessarily understand capitalism has to change in its form and substance. Now, we have to come to terms as a public-private partnership world over. You have to create a new business model. That's what is evolving. Look at the corporate greed we have seen. Investment banks knows consciously they have created a product which is toxic. We clearly know these are not asset-backed, these are asset-based. So there's no question of lack of regulation alone. Clearly, conscious corporate crime was committed. And world over, whether it is security exchange or regulators, have not looked at the systemic risk. That's the definition of the problem. Today, monetary policy and fiscal policy has to be altercated to see there is an absolute convergence between politics and economics. Then only the world will be at large in balance. Developing economies and developed economies have got their contentious issues. Whether it is Kyoto Protocol or a Doha development round, there will not be a proper balance unless the contentious issues are resolved in a balanced form.
Well, Peter there raised the issue of the dollar as the reserve currency. Do you see that ever changing? Because we've now seen a situation where the IMF has got a quasi-currency that China and Brazil are buying into because they wanted to avoid the dollar. Do you think the dollar will ever be replaced as the reserve?
It's possible. Conceptually, if you look at it, it's a question of time. See, if dollar as a universal currency was prevalent over the centuries, now we have seen the trade gap between China and United States. We have also seen the emerging economies are at stake in clearly. That's why inclusive growth, G7 has become G20 today. They have to necessarily be integral part of the IMF voting. And there has to be a wholesale reorganization when it comes to economic sayings. Global governance has to be altercated in its forms and substance. So question of currency realignment will also come in. That's why if you look at the Gulf, they're going to have currency union. Clearly, we see the roadmap. The governors of the central bank in the regions have pronounced by 2010 and 2011. They'll set in convergence criteria. So you have to look at your own trade bloc, and make sure there is a universal framework within your firm, and we promote the trade, investment, banking, and finance at large.
Alistair, what do you think? Do you agree with that? That there'll be a rebalancing of influences from countries like Russia and China?
Well, clearly, America's influence will wane over time, and there's no doubt about that whatsoever, especially with the kinds of policies they're pursuing at the moment. The big fear, I think, for countries like China is that the dollars, the huge numbers of dollars that they hold, will lose a lot of the value if America inflates its way out of trouble. Also, I mean, to be honest, it's not a healthy situation. But the biggest problem is twofold. I mean, one of the biggest problems is the West has not been saving enough. In part, that's because in America and Europe and so on, there's no real pension systems that are funded. People don't have to save money every year and save and accumulate this wealth to pay for their retirements. And at the same time, the countries like China and so on have refused really to allow their citizens to spend enough of their money, and they've had these mercantilistic style policies to boost exports at all costs, for example by undervaluing currencies and so on. The combination of these two things has meant that the Chinese have hoarded vast amounts of dollars, and these dollars have been invested often in American government bonds, which has pushed down interest rates far too low and allowed a lot of this speculative frenzy to develop. So it's these huge imbalances created by flawed government policies, both in the West and the East, that are one of the main drivers for these bubbles. We have to tackle this, and at the moment I don't really see any sign of that happening. Let
me just take up one of your points, Alistair, about saving. And the tricky question of whether this could happen again. The former Federal Reserve Chief Alan Greenspan said he's convinced it will happen again because of the unquenchable capability of human beings when confronted with long periods of prosperity is to presume that it will continue. Alistair, I want to ask you, do you think the current crisis has changed any attitudes?
I mean, the problem with Alan Greenspan is that he's one of the main people guilty for all this bubble. That's the big problem. So, frankly, I don't really want to hear too much from him anymore. But I don't think...
But what about attitudes in general? Because we're in a very different world today than we were 12 months ago. So I guess what I'm asking is, could this happen again?
Well, it could happen again if the same stupid policies are pursued again. And at the moment, I mean, I do think things are changing. I do think some of the policies will change. But ultimately, I don't see, you know, the central banks have pumped huge amounts of liquidity into the global economy to try and boost it, basically. My worry is that they will continue doing this to such a level that they will begin to inflate another bubble in a few years down the road. I think that's quite scary. I think in other respects we have changed. We have, you know, the banks all over the world were told that they could only needed to hold small amounts of reserves, you know, to guarantee themselves against loss. That's the rules they were following, the Basel rules and so on. These rules turned out to be ridiculously risky. And I think all over the world people have realised that banks have to hold more capital. There is some progress, but I think you could easily have another bubble like this. And unless we understand the profound economic reasons for these bubbles, which we've had you know, for centuries, all these bubbles have been led by too cheap money that's too cheap. And when you give people money that's too cheap, it's like giving them too much alcohol. They get drunk and they misbehave. And there's no rules that can prevent catastrophe when that actually happens. So the key is to prevent excessive liquidity in the global economy in future.
Peter, I know you're also worried about the effect that these stimulus packages could have on the economy if we don't pull out of them soon enough.
Well, remember, the stimulus are the problems. We're overdosing on government stimulus. The stimulus are actually sedatives.
But the stimulus, weren't they necessary in the first place? I mean, a lot of analysts say that without them, the situation would have been a lot worse.
No, those analysts are wrong. Those are the analysts who didn't predict this problem. Those were the people that said everything was great back in 2007. They were wrong then, and they were wrong now. We have to stop the stimulus. The solution is the recession. The unwinding of these economic imbalances is a problem. But unfortunately, we have to deal with these consequences.
But hang on, if we hadn't had these stimulus packages, wouldn't there have been a huge knock-on effect if giants like...
Of course, but that's short term. But in the long run, the problems of the stimulus are worse than the crisis. As I said at the top of this program, what we're going through now is the result of the government stimulus in 2001 and 2002. If we had simply let the NASDAQ bubble burst and let that recession run its course, we never would have had a housing bubble. None of these problems would have happened had the government let the free market function years ago. We didn't do it, and now we're paying the consequences. And the reason that nobody's saving in the United States is because interest rates are much too low. Inflation is faster than interest, so nobody wants to save in the United States. People want to spend money. They want to, whatever money they don't want to spend, they're buying gold, they're sending it abroad. We cannot resolve our imbalances based on what we're doing. And, you know, the problems for China, sure, China has a lot of dollars. They have to bite the bullet and take their losses, because the more dollars they buy, the more they're going to lose, because we can never repay. And the problem is, the more treasuries China buys, the worse the U.S. economy is going to get, because all this money is being spent. The money that we're borrowing from China, none of it is being invested. It's all being consumed. It's being used to grow our government, to undermine our free market economy. And so the more money we borrow, the more money we're going to need to borrow. And we're never going to pay any of it back. And so the longer the Chinese and the Japanese and the rest of the world wait to stop loaning money to our government, the more money they're going to lose and the more screwed up the U.S. economy is going to get.
Raghavan Sitaraman, what do you say to that? We're causing more problems than curing.
Clearly, see, you have to live within your means, whether it is individuals, corporate or countries. We have to come to terms. Just by having quantitative easing, printing money is not the solutions. In real economies, you have to have saving power. People are living beyond their capacity. That's the definition of the problem. Look at Lehman Brothers. It was 78 times leveraged. That is the definition of the issue. Conceptually, you are overstretching yourself in your day-to-day, and the balance sheet is weak. That's what the stress test reveals. Clearly, the profile of the country needs to be measured again. You have to minimize the risk, and you have to operate within your means, within your resources.
Is it right that the companies like Lehman Brothers got so big that the possibility of their collapse was impacting on a huge part of the economy? Is it right that companies can get that dangerous?
Absolutely. Look at the way they overstretched. Investment banks consciously, without underlying fundamentals, they were ballooning themselves by building the brand equity. And world over, they issued the toxic assets. They were expanding the scale of their operation. Clearly, that's
the best way to make sure that doesn't happen again is to let these institutions fail. When the government says that they're too big to fail, you get the moral hazard. And now people will lend them money because they're not worried about default, because they know the governments will bail them out. If you simply let markets work, if you let creditors suffer losses, if they lend money indiscriminately, then the free market will regulate these companies and prevent them from getting too big.
Alistair, what do you think? Should companies like AIG and whatever have been allowed to have failed?
We need to find a system whereby big banks can fail. And obviously, a year ago, everybody was so panicked that they thought all these big banks are going to fail in a domino effect and it would take down the whole world economy with them, that the money supply would collapse as a result and all that sort of stuff. There was a lot of opaque transactions going on. So especially the case of the AIG, for example, no one had a clue what would happen at the time if AIG were allowed to go bust. No one knew whether the counterparties, the other banks that were trading with that giant insurance company, would be destroyed as a result of allowing AIG to go bust. And that at least was one of the rational reasons for bailing AIG out. What we need to do is to make things much, much clearer, much more transparent. There needs to be much more information around everybody, all the regulators. There needs to be better markets. There needs to be more information and so on.
But can you have a true free market without with all those regulations? Sorry, I'll repeat myself.
No,
can you have a true free market with regulations like that?
If I have to
no, the point I was trying to make was, you need to be allowed to. These big banks must be allowed to fail, and for these decisions to be taken, you need much clearer information. People need to know what the counterparties are. So, for example, I think some of the proposals to move a lot of these derivatives onto exchanges make sense. It will allow more transparency and so on. The problem is now there's massive moral hazard in the system. Everybody now thinks no bank will ever be allowed to go bust anymore. And so, in a way, we're in an even worse situation now than we were a year or 2 or 3 ago.
Raghavan, I know you want to come in. We're running out of time. What's your comment?
I think I have a different view. See, a public financial institution is not a supermarket, just the proprietary capital or a shareholder's money. You take the public deposits. So you have to necessarily, framework has to be strong. You have to prevent these kind of happenings. You cannot allow your financial institutions to collapse. That will have consequences across the globe. Conceptually, it's consumerism. So it is the shareholders' money based on which we go and borrow public money. Based on the overall buying of money, we sell the money in the form of advances. Conceptually, a lot at stake in terms of business collapsing as a financial institutions. So the consequence is very, very, very high, domino impact. That's what we have seen. One Lehman has created so much impact across the globe. What is important is to define the framework, establish the governance properly, and make sure we don't have failure anymore.
Okay,
that's
gentlemen,
the framework we need.
I'm going to have to leave it there. It's been a really fascinating discussion, but I'm afraid we've run out of time. Thank you very much to all my guests today, Alistair Heath, Peter Schiff and Raghavan Sitaraman. And thank you for joining us here on this edition of Inside Story. Do send us your comments and suggestions. You can email us at insidestory@aljazeera.net. But for the moment, from me, Shuli Ghosh, bye-bye.